Greetings, this is Dr. Jeffrey Scott. This is my weekend market update for the weekend of August 7th, 2022. Just a quick note, I am on the road. The sound is not great. I'm still working to fix it. It will get fixed. But I'd rather do this than not. I titled it The Bear Market Rally Still Lives, and I'll show you what I'm looking at and what I'm thinking. Whether it's on its late and last legs or it's really the beginning of a new bull, hey, I think that jury's still out. As always, it's for educational purposes only. Anything I recommend in the spirit of education should not be considered investment advice. I'm a doctor, not a broker. Any tools that I demonstrate are those that I use in my daily trading. I've paid for all those tools, and trading involves risk, and you alone are solely responsible for any investment decisions you make. Let's bring up my spreadsheet. Now, those who've been watching me for any length of time know that I like to go through a lot of different software tools, and to do it in a way that allows me to, it didn't work the way I wanted it to work, go through a lot, look at the market, and to do it in a way that is quicker. So let's take a look at the markets that I see. We'll start here with the spreadsheets. This is created from two warehouse views in HGSI. And what I really like to look at is the intervals off the highs and the lows. If you look at the 5-day performance, and the yellows represent the major indices, you could see big caps were kind of flat over the 5 days, while small caps and technology were up close to 2%. That's kind of a divergence in the market, and one that's probably worth keeping an eye on. If you look at since the 52-week highs, and you could see 52-week highs here on the big caps were in early 2022, and the small caps and Russell started, and technology rather, started dropping in November 2021. And you can see the big caps are off 11 to 14%, and the small caps and technology are still down over 20. Now, what's interesting to me, probably the most interesting thing on the chart, is if you look at the percent current interval to 52-week lows. The small caps and technology are now near positive 20% off their lows. And that just is sort of the evidence that, bear market rallies can be impressive. 50 days, 20%. If you look at the large caps, which are not down nearly as much, they're much more muted off their lows, closer to 10%. So I think that's kind of interesting. You could also see the lows of June, except for in the NYSE, are pretty much the lows that we're looking at with this rally. On one-day moves, again, you look at the major indices, pretty flat, regardless of what you're looking at. If we look at the Q Edge tool, I like to see how the market's been doing over time. These three boxes up here, sectors half 55% green, industry groups 56% green, and stocks up 57%. That just tells you how neutral Friday finished. Buckets, you notice here that we have only 5.7% of the stocks are above the Bollinger Band, 2.2% below. That's kind of approaching more of a neutral stance, although over 3/4 of the stocks are still above the midline. This came off a heated picture last week. So if you felt some pain this week, probably it was earnings related, but probably it was also the market took a pause in some areas. If you look down at the bottom, you could see here's those Friday numbers, sectors, industry, and stock. Here's 5 days, so a pretty balanced week or neutral week. But when you take a 10-day look or a 1-month look, it's decidedly bullish. Now the warehouse reports, I don't usually keep last week's report, but they're so different. And I guess it's just another way of looking at rotation. So just to give a little background here, this is a tool EdgeRater does a lot of different analysis for me. But what I'm doing here is I take a snapshot of the market every Sunday. And then the next week, I run through and I look at how did stocks perform based upon certain things. In HGSI world, one of the things is called ERG, and ERG stands for EPS rank plus relative strength rank plus group rank, and the higher the ERG, the higher the growth. Now, if we look a week ago, the results showed that higher growth had better performance, higher earnings, higher relative strength had better performance. And stocks that a week before, because remember we're using the fundamentals of the prior week, stocks that had performed well the prior week outperformed. Now look at this curve. The good news is almost every data point is above zero, so it was a very positive week for some. But look at this, low relative strength led. High earnings per share rank didn't matter. Stocks that led the prior week underperformed. So there was great rotation last week. Now, this is another thing from EdgeRater that I combine with some HGSI stuff, but I want to get a sense of what's going on in the market. And one of the things that I like to look at is Hindenburg-Omen. We're not going to see one for quite some time because you got to get back to new highs. But there's a lot of data that comes out of it. So one of them is the percent new highs and new lows. And notice this orange here, these were all above 2%. Some of these were really hot numbers, like plus 25% new lows, 20% new lows. And right now, we've only had one day here where the percentage of new lows was above 2%. So the percentage of new lows is definitely dropping, and that's probably good news for the bulls. Still don't see much in new highs. Notice the weekly bongo stayed green, and these are the same numbers you saw here. And you could see off those June lows, we had a bit of a pullback here, but we've really had a sustained move. That was the NASDAQ. The NYSE, similar story. Nothing above 2% of late on new highs or new lows. The weekly bongo is green. Buckets. Now this is similar to the upper left-hand corner of the Q edge. And again, 78% of the stocks, the S&P 1500 above their midline. Now what I wanted to show you is what a difference a week makes, because this is the current number of stocks either at the top of their bands or above them, and you contrast that with what they were last week. So a lot of stocks paused, some pulled back, some probably went sideways, but you had a reversion to the mean. Now, the same thing happens to the downside, and you can see here 96% of the stocks are below the Bollinger Bands, and so many here, 96% are below the midline, and you had 20% plus below, and this is when the market reversed and started going up. Energy had a rough week. Oil down 10%, coal down 11%, heating oil down 9%, and I guess the big message to me here is, if this is such a big reason why we have inflation, will this lead to falling inflation? On the metal side, on the week, not big moves except for titanium, which I don't trade. And I think the big thing here to point out is the Baltic Dry Index just continues to fall. So Star Bulk Shipping, Zim, other dry bulk shippers, their prices often track the spot price for the Baltic Dry Index, and it's down, and so are they. Interest rates in white, you can see they picked up this week. And more importantly is this chart here, which is the yield curve inversion. And so I was shocked over the last couple of weeks, shocked, surprised, how the yield curve keeps getting more and more inverted and has not reversed. So if you go back to the mid-80s, you can see that each time that happened, we followed by these gray bars, which is a recession. Now, whether it was be a very short recession, like we saw in 2020, or a bigger recession as we saw in 2007, 8 going into 9, remains to be seen. The credit risk seemed to have come down, and I kept this chart in here just to remind people, if you don't remember what happened at the end of 2018, and this is when that credit risk spiked, the market sold off. Overbought, oversold. Stocks above the 200 increased. Stocks above the 40 really increased a lot. Again, talking about pause to refresh or mild pullback in some of the extended areas, the number of new high, new low ratio over 13 weeks actually pulled back some. Economic news this week, I don't think there's such thing now as a light week. You've got some auctions, you've got a CPI that should be pretty impressive or important on Wednesday. Petroleum, you've got Fed heads speaking. On Thursday, you get the jobless claims, final demand PPI. Not as much stuff going on Friday, but consumer sentiment, when it comes in low, does not treat the market well. Still have a lot of earnings, as you could see here. Now, these are a lot of the smaller names like Palantir, Veru, Rivian, etc. Big leaders in Celsius. But, as I like to say, it's a judgment call to hold the stock over earnings. It's pretty much bad judgment to not know when your earnings date is falling. Last week was one of the first weeks in a long time where the expected moves across the board, the E-minis, the NASDAQ, the Russell, the Dow, the Russell, the dollar over here in the VIX all finished within their expected move. So really not a giant week, and I think we saw that when we looked at the 5-day performance. What are my thoughts? Despite two of the main indices closing with modest losses, the market showed resilience to selling on Friday. On the heels of the hotter than expected July employment report, there was another sell-off midday before the indices climbed off their lows and moved sideways to the close. If you were watching the open on Friday, you saw the market trade down significantly on the employment numbers. It was pretty impressive how the market returned. The first week of August ended up being another winning week for the market. Wasn't easy though, as there was a lot of counter currents. Beneath the gains, we saw a shift in what worked, as we saw a lot of junk off the bottom. Biotech, which I hate to consider junk, had a huge run. Well, if you look at the price of the Biotech Etfs, they did turn into junk. There were a couple of acquisitions, one by Amgen, one by Pfizer, I think one by Gilead. And I think what that's doing is sparking interest in the beaten down prices on some of the smaller biotech. Now, why would that happen? I get a lot of calls because I'm in healthcare. When we as individual investors see something that's valued more than the market gives it credit, we might buy that because it's a stock that we think is going to go higher. Turns out, big pharma and biotech, the way they replenish their pipelines from time to time is they look for companies that might have decent assets that are very undervalued. They don't buy the stock, they buy the whole company. That is why I think we're seeing a big run in LABU, for example. The other reason I think we're seeing a run is the massive increases we saw in 2021 in biotech were led by Moderna, which approached 500 and then has recently dropped down approaching 100. Moderna had great earnings, is starting to move, and that's probably moving the biotech ETFs as well. So we'll still have news flow, inflation, Congress, Russia, China, weekly employment. We're also in the midst of the busy part of the earnings season. Question remains, are we in a new bull or just a stronger bear market rally? We've struggled near resistance here, but we have not had a substantial pullback, just rotation. So I don't think anybody can say for sure. So many people are out there saying the bottom is in, the bottom is in, and some of the traditional bears in this market have come out and said much deeper lows are still to come. I'm sort of on the fence. I've seen enough that it was reasonable to put more of my money to work, but I still have cash. I've avoided margin, and I'll be nimble and trade the market we get. One of the great advantages of being an individual trader, like most of the people who listen to me are, is we can be nimble. Unfortunately, and I say that tongue in cheek, none of us have $200 million accounts that we can't move stocks very quickly, that we can't buy or sell quickly because we'll move the price. So we can get in and out where the big guys have to do it in a more careful fashion. Lastly, before I jump into wealth charts, stocksanddocs.com, that is a website that I have put up. It is just videos. There's nothing else there to date. I'm trying to build a library of videos, but it's also a great way, frankly, of not proving anything, because you're not paying me for this at this point, but demonstrating what you can do with good tools and showing you how I look at the markets, how I pick stocks, but also giving you a video recording that you can go back and test and see what happens. So I invite you to use it like most of the things I do, except for the best scanner in the market inside of wealth charts, things that I do. First, I just want to show you something that is new in the program. I mentioned it last time, but it's really awesome. And that's this hot stocks feature. If you go into any of your wealth scanners and you hit the little funnel, there's now a button. Let's make this short term, called hottest moves. Make sure that's turned on and applied. And what you'll find is some of the hottest stocks at a given time are going to move to the top. And if you're looking for things that are moving right now, these are a great way to find them. If you see this little fire symbol, flame, on other lists, just keep in mind that those are things that are moving right now. Let's go into the indexes, because that's where I like to live, because I'm a top-down guy. So here is the spiders. And let's go back to the June highs, which were around June 7th, the June lows on June 17th, and notice sort of indecision at the top here with a bunch of doji-like bars, indecision at the bottom with a doji bar, indecision at the top at the June highs. To me, the June highs are the current line in the sand. We have tried to get above them. We have failed. This market is, this rally stalling until it breaks above those June highs. That said, it hasn't broken down yet, and you continue to have higher lows in this market. Got to get through those highs. Notice the weekly bongo has been green for a while, and just to prove that you're not extended, if you look at the little red line here, 18.34, the high jump is kind of neutral. So that's the spiders. I'll contrast that to the NASDAQ, the Qs here, NASDAQ 100. There you go. The Qs have broken through the June highs decisively and are in this really tight channel. This is really bullish looking. Up and down, up and down. So we're in the middle of the channel. We're above the June highs. Not only are we above the June highs, we're probably going to get close if we keep going up to the 200, which is my next target. And we shall see what happens. Will we go beyond that? Who knows? This has been a nice run, as we showed you earlier, about 20% up on the NASDAQ 100 since this bounce occurred. The diamonds, we'll just look at it here, stalling underneath the June highs. The Russell had a great week. And if you look at the Russell, it's right up here and closed at the June highs. So the Russell now, again, what you want to see here are higher lows, and higher highs. So can we bust on through? If we can, next target's 200, where that 200-day moving average is. So I think the market's at a very interesting junction right here. VIX is doing nothing, and dollar has a red candle on Friday, but it gapped up, was actually up a little bit less than 1%. So markets are interesting. Commodities, if the dollar was up, then you know that gold and silver failed. And we make silver back to a daily rather, and they both ran up to the 50 and turned down. I don't think I'd be playing a lot of gold until it got above that 50. Oil is back down to the 200. Natural gas is trying to mount a rally off the 50. You could see the 10-year had a pretty strong day on Friday, and that was after the very strong employment numbers. I think they blew all the expectations out of the water. you can see what happens when rates fall. Value versus growth. Growth takes the lead when rates are falling. When rates are rising, value takes the lead. So let's see what happens here. We're still above the 50. That could be resistance. If we look at my simple market timing model, which is just looking at two things, it's looking at price versus a 30-period moving average. I have switched to the WMA, and I'm looking at the weekly Bongo. When both of those are positive, as they are in each of the 4 major index ETFs, I'm pretty bullish on the market. So right now I'm bullish, but I'm hesitating. I'm hesitating because we got to get above on the spiders and on the Russell and on the diamonds, which is probably the lagging one here. We got to get above those June highs before we can take the next assault. Now, the Guppy charts I don't look at on these every week. I do like to follow them. And we're now inside the moving average channel, which is great because we're on the way towards breaking above it. A break above the moving average channel, I'll deploy more cash. Maybe even start to think about the dirty M work. Margin, which is not for everybody. I don't advise it. And if you think that margin's great, make sure you talk to your financial advisors and you know what you're doing. But we're not there yet. We're still in those moving average channel. Now, if you want to see what market rotation looks like, here's a daily chart on the left of IWB versus IWM. Large caps leading up here. If you're down here, small caps. So yeah, we've turned down of late, but you could see since March, just a massive rally favoring large caps. If you look today at spider growth versus spider value, growth is up here, value is down here. We've clearly bounced and are facing moving up. But if you want to see what the difference on the hourly chart, we're living in small caps and growth. Well, what's small cap growth? That's what we buy. CanSlim, high growth stocks. That's what I live for. That's why the market seemed a little bit different lately. Hourly S&P 500 sectors compared to spiders, ratio charts. The winners last week, I left the same. Clearly, technology is leading this market higher. Industrials lagged a little bit, but still when you look around, the only other thing beating industrials is discretionary. Now, are staples starting a comeback? Well, they fell pretty hard. They had the blue there, real estate, utilities. So defensive things stirred a little bit on Friday, but I'm going to stick with discretionary industrials and technology. The other thing I'm going to stick with is just show you something that's cool too. Duplicate the chart. Let's put it over here. So you could see that healthcare has really weakened. Healthcare is a lot of different industries and a lot of different stocks. I started this discussion talking about biotech. So let's look at IBB and make sure, oh, come on. There it is, that you use the built-in, not your third-party data set for what I'm going to do here. So I changed this to IBB. Now I'm going to do an IBB versus spider ratio chart. Look at IBB, what it's done. IBB's had a massive run off the bottom. So healthcare doesn't look so great. But, whoops, that's a spider. Let me do that again. My bad. IBB, SPY, hit this thing. There you go. IBB has had a big move. So IBB is probably up there with the leaders of this market. Let me take that out. Perfect. Now, let's go into my scanners. So there's a lot of scanners. I'll show you my personal scanner, the CAT scanner, which is available through Wealth Charts. The indicators, for the most part, are built into the program for all users. What really makes the indicators hum is the scanners. Heat map. This is how Friday looked. It's red. Now, despite that, several people I talked to actually were positive on Friday, and most of them are heavy in biotech. Now, that'll work until biotech stops. But again, as long as you start to see strength in Moderna and other vaccine plays, and you continue to see pharma and large cap biotech, the Gileads, the Amgens, the Regenerons, buying up these small biotech companies. You'll probably continue to see strength in biotech. Sector scanner, this is important to me for many reasons. I start each day by looking at the daily movement. And interestingly, on Friday, I'm going to click the strength, energy and healthcare. Okay, let's look at the weekly change, technology and discretionary. So these are the four sectors that I'm going to concentrate on my top-down review. Healthcare, technology, discretionary, and energy. Energy is lagging, but it had a very strong end on Friday, so I want to keep that in my group. Now I'm going to hit compare, and what comes up now are the leading stocks, leading industry groups in the leading sectors. So let's look at daily change, and let's go down and take everything above 1.5%. Oops, went the wrong way. And the reason why I did that is because I have to click that one and then click this one. Now let's look at daily algo and see if I'm missing anything. Recreational, doing. See, some of the technology things were weakened a little bit on the one day. So now I'm picking all the groups that made this either through the algo or through one-day performance. Now I'm going to compare, and this will bring up the stocks in these groups. And what I'm going to do is I'm going to skip the first couple because, well, actually, let's do this. Select price has to be greater than or equal to 5. And volume, because I'm only interested in stocks that have greater than or equal to 500,000 shares, I'll give a little breathing room, 350,000. Oops, make sure I don't put. And now let's apply. All right. Well, and let's take daily algo scores, and let's take everything above, say, 650. All right. So I'm going to hit that one, hit Shift key, and now I'm going to go make sure my watch list is my weekend review. Perfect. And now what I'm going to do is I'm going to add all those to my watch list. And you should see something open up in the right-hand corner. Not up, there you go, and it's adding the symbols. So now when I start to do my scanning, I'll be able to look at the top stocks and the top sectors and the top industry groups. Now, for those that follow me, I also build a list called a combo buys, which comes from a number of different scans and published lists that I follow, and I've included that in the weekend review list. Back out of those, let's go to the wealth scanner, get a sense of what's moving in this market, and I bet you're going to see biotech. I'm just betting. What do you see? IBB, XBI, different components, biotech, small caps, interesting Fidelity Magellan, solar still strong, genomic revolution, Fidelity NASDAQ Composite, regional banking, talked about that last week, more banking, technology, and then industrials. Whoa. I like it when things are consistent, the different ways I look at them. Now let's go into the CAT scanner. Now, one way to do this is let's just put the weekend review, and let me just show you my filters and make sure, I want to make sure they're set up right. 5 and 500,000. I want them to have options, so I put greater than or equal to 1. You have to have at least one bullish dot because I'm bullish, not bearish. Bullish to neutral bullish. Bearish dots less than or equal to 0. And I'm looking for stocks who the Bongo Daily 5 days ago tells me it was in a sell mode and it turned to a buy with sometime last week. And let's go down and make sure my weekly Bongo is set as bullish. So I am looking for stocks that have been going up long enough that the weekly Bongo has turned green So they're in a longer term uptrend. And the fact that their daily bongo reversed within the last 5 days means they've had a pullback and then now have switched to a short-term buy. So let's take a look at that. Awesome. So let's double click on dots. Okay, so here is the entire weekend review, and you could see that everything has a weekly bongo in it. Everything has a daily bongo, and the daily bongos are rather short duration. So let's just look at CPS. Cooper's, don't even know what this company does. And so this is an inexpensive company, and it had, as you can see, it's fallen a lot from 28 back in January down to $5 or so. And what happened on Friday, I don't know, but I see that it had volume, breakout, momentum, PSAR reversal. It just came out of a squeeze. It has a daily and weekly bongo. Look at relative strength that OBV did. Don't know anything about this. I would want to make sure it's not a takeover candidate. Maybe it bounced on earnings. I might look at that one. I do know I like DVAX. This is a biotech company. This is one I've talked about numerous times. It gave you a buy signal back here in May on huge volume, 3 dots, EMS fired. It's now much less risky from a overhead supply perspective, as it's now taken out everything since November, but it's starting to get a little extended, although the high jump's only at 63. So DVAX had a new EMS. It had 4 dots, so it had a big gap, big volume, breakout momentum coming out of a squeeze, PSAI reversal. All 3 time frames, daily, weekly, monthly, are green on the bongos. Great move up on relative strength and OBV. I could be interested in DVAX. Progeny, I used to know what they did. Again, did they have earnings? Probably, or was it a takeout? Don't know. But look at this play here, 4 dots, huge volume, also looks interesting. So right away, we see there's a lot of stocks there. If you want to play news, and I don't necessarily suggest it, Bluebird Bio is trying to get one of the first gene therapies approved, and they have sold off dramatically. As an oncologist, I'll tell you, I like their data. But you can see how far they've sold off. They have a PDUFA date that's coming up, and that's a good thing for me to mention. When you buy a stock in a non-healthcare company, you're going to worry about earnings dates, earnings surprises, warnings, news flow that could affect that industry group or sector. Most of those are predictable, except for a warning. When you buy biotechs, you got all of those, and then you have risk of failure of a drug, an FDA denial. So this guy's coming up for an FDA meeting. I think it had its big bump because it's attractively priced for a takeout, and we'll see what happens with the FDA. Now, not long ago, I had another stock that had an FDA decision, and that was CTIC. And what I want to just show you here is not everything has to be bought before the FDA makes a decision. To the left, this is what CTIC looked like for months. I know the company, I know the drug, not an insider, and the problem is there's nothing sexy or exciting here. In fact, on February 28th, it had 3 red bars, it couldn't get above the 200. There's absolutely no reason why I would have been wanting to buy this stock on a chart. So what happened? Let's see if I can advance this one. The next day, the drug got approved. So yes, I could have, would have, should have. Maybe I would have been the guy buying it at the low at $1.90. Worst I would have bought it for was $3.05. Now $3.05 is a 50% move more off the $1.90. So But is it worth the risk? Because I'll tell you what the stock would have been if they got denied. It would have been 20 cents, not $2.20. Now, the reason why I say you don't have to buy them before they get approved, because look what happens after the drug got approved. So now the stock, pull it back down because it's gone too far. It was running up before biotech started running. It closed at multi-year highs just off the high. Whether it's a takeout candidate, I have no idea. But they got a good drug and they got it approved. So when I go back to blue, you could buy it here if you want to. It's like a $5.59 option. It can go to zero. If this drug approved, it probably goes to 20 bucks. You got to roll the dice, and you could also wait until the day it gets approved and buy it before it gets to 20 if you're lucky. Now, since I'm liking biotech, I might want to change what's in my weekend review and go look at biotech. And I've created groups for major industry groups, especially ones that I like. So in biotech, DVAX is still the one that comes to the top. I like that chart a lot. AERI, this one comes up. Let's take a look at this. It had a big move, still a cheap stock. It's down from the 20s. Don't know anything about it. Chart's kind of loosey-goosey. We already looked at blue. Denali Therapeutics, this once ran a lot. Previously a $100 stock, now it's $35. Now what's nice about this one is it's had a big run up, pull back, and now it's going up again. The weekly is in a uptrend. This one looks interesting, Denali. NBIX had a big move on Friday. So there's bull market somewhere, Kramer used to say. I think the bull market right now is in biotech. I would do my reading, understand why this ran, but it's probably running because the entire industry group is running. Here's one that I talked about. I know a lot of people were in at my meeting that I did back in, I think it was June. And look at this, run up, pull back, and a big move on Friday, Vertex, which is one that I like a lot. So I've shown you some really cool stocks. I talked a little about why biotech is running. I think I've given you a lot of things to look at. Do your own analysis. There are other things that are working. You don't have to buy an individual biotech stock. Again, these are risky stocks. Sometimes ETF is a lot risky. Doesn't look too far gone, does it? This was $187 in the heyday of Moderna, and it's now 12 bucks. It's come up off of 4 bucks over the last couple of months. Does it have more legs? I think so. I'm in it. And it's a way of avoiding individual failures. Nothing should be done because I'm in it. And you need to be careful and have stops and don't have crazy position sizes. We saw that some of the bank ETFs are working. So regional banks, there are a zillion of them. Maybe you should just buy the ETF. It pays a dividend. Does it look interesting? I don't know. Yes, it looks interesting, but it's pretty down in the pattern. I looked at JP Morgan as a big bank, and I was kind of impressed with the chart. Why? It looks like a biotech. Here's a class company, a leader, has really sold off from 172 to 115 since October. And it's starting to look interesting. It's squeezing. Relative strength and OBV have not broken out yet. They're getting close. Maybe I'd be interested more if it breaks above that yellow, which is the 50. But JP Morgan actually even looked interesting. TAN, I guess it depends on which one you buy, but TAN, the solar ETF, is another one that was on the list of Wealth Scanner. And that has broken out. Now, that's a junky looking chart. Now, if you were in EMPH, one that we've looked at multiple times, you would be very happy right now as it had a great run on earnings. The tough part is then you look at SEDG, for example, and it did not have a great earnings. So you have to, it's tough. Now, We've talked about DQ as well. I think DQ's earnings are yet to come. And this one looks like it's setting up to do something. Whether it goes up or down probably depends on earnings. It's now going into a squeeze. And we also talked about JKS, Jinko Solar. So mixed bag on solar. I wish they all looked like Enphase. So on that note, I think I'm going to say goodbye. So a couple of housekeeping notes. One, I am on the road. I'm going to try and get my better microphone working and figure out the sound problem I had today. Two, I'm on the road, therefore I may not be every night on the videos or every morning. It depends upon life things. And I sound bullish on this call. I have a lot of things I like in this market. We got to get through the June highs on all the indexes and probably retest them. That note, have an awesome week.